It hit my inbox at a time nobody sane is awake. 3:47 a.m. Eastern. A single encrypted attachment, no subject line, just a short message that said, "This isn't supposed to exist. If you trade silver, read it before Monday." And inside that attachment was a file that looked harmless, almost boring, like the kind of spreadsheet you'd ignore if you didn't know what it meant. But here's the problem. If this document is even half real, it explains why the silver market has felt off for months, why prices whip around on thin news, why delivery delays keep quietly stretching, and why suddenly industrial buyers are acting like they're shopping in a store that's about to lock its doors. Because this spreadsheet doesn't read like a rumor. It reads like a balance sheet confession. And in the first 15 seconds of this video, you need to understand exactly what the alleged leak claims happened. It claims one London bullion bank was sitting on a mountain of paper silver promises, tens of billions of ounces worth, while the truly deliverable metal, the kind you can actually hand over, wasn't tight. It was microscopic. So if you've been wondering, what would it look like if the paper silver system finally snapped? I'll show you. This is what it would look like. A quiet file sent in panic, showing a leverage ratio so extreme that the old numbers people argued about for years suddenly look like children's math. Now I'm going to walk you through what the file allegedly shows, why the numbers matter, where the infamous 4,000 to 1 idea comes from, and how a system like that can appear stable, right up until the moment it isn't. And as we go, I want you to keep one question in your head. If you discovered your silver wasn't silver at all, how fast would you try to turn it into something real? Before we dive in, quick and simple. If you want more breakdowns like this, markets, metal, and the moves nobody explains clearly, tap subscribe. Short, fast, done. Because what happens next isn't going to be calm, and you'll want the updates when everyone else starts pretending they saw it coming. All right, here's the story the spreadsheet is trying to tell. According to the message attached to the file, the document was dated January 14th, 2026, and marked for executive eyes only. It didn't come through a public leak site. It didn't arrive as a dramatic whistleblower dump with a cinematic soundtrack. It allegedly came from inside the compliance side of a London bullion operation, and it was forwarded to a tiny circle: traders, a journalist, and someone with a regulatory contact. And the file itself? Not a manifesto, not a report, not a memo. Just raw rows and columns, account codes, categories, quantities, and something that should make your stomach drop if you understand how these markets work. Claimed ounces next to allocated ounces, because those two columns are the difference between you own metal and you own a promise. Allocated is the clean version. Allocated means specific bars, specific serial numbers set aside. It's not a vague IOU, it's not a pool, it's yours, on paper and in the vault. Unallocated is the foggy version. It means you're owed metal, but not a particular bar. The bank can run that pool like a fractional reserve system. Most clients don't ask for delivery, so the pool can be, let's call it, optimized. Now, the spreadsheet allegedly summarized thousands of client lines. When you total the claimed ounces column, the number reported in the message was shocking. 61.8 billion ounces, billion, with a B. Then you total the allocated ounces column, the hard, specific, deliverable ownership, 3 million ounces. Read those numbers again, slowly. 61.8 billion claimed versus 3 million allocated. If that's accurate, that's not tight. That's not low inventory. That's a structural mismatch that only functions as long as the public stays asleep. And when you divide those numbers, you get a ratio so absurd it sounds fake. Roughly 4,300 claims for every single ounce that is clearly allocated in the dataset. Now, to be responsible, I have to say this. We cannot independently confirm the authenticity of this spreadsheet from here, and you should treat any leak like this as unverified until proven otherwise. But we can still analyze the logic of the structure it describes, because even as a hypothetical, it reveals how the system would have to be built for these persistent stresses to exist. So let's continue, because the spreadsheet story doesn't stop at claims versus allocated. That's just the appetizer. The next part is what makes the whole thing feel like a trap door. The spreadsheet allegedly included not just client balances, but also a category for derivative exposure: swaps, forwards, bespoke contracts, off-exchange agreements, where a bank sells silver exposure without needing to show a futures position the public can track in real time. And if you've ever wondered why markets can look calm on the surface while something huge is building underneath, this is how. According to the narrative attached to the leak, the notional derivative exposure was over $1 trillion at one institution. Not a lot, not large. A number so big it only exists in rooms where suits speak in acronyms and the consequences get pushed to later. Now, if you convert notional dollars into silver ounces exposure, Using a spot price around the high 80s per ounce, you get billions more ounces of obligation. And the spreadsheet claim was that when you add the account claims plus these derivative obligations, the total silver the bank could be on the hook for was in the neighborhood of 78 billion ounces. Pause there. 78 billion ounces owed on paper, in one way or another. Then comes the part the leak says most people miss. You can't treat every ounce in the vault as available, because a vault can be full and still empty. How? Custody. If a vault holds metal as a custodian for a third party, like a giant ETF or a sovereign account or a segregated client, those bars are not free inventory. They are present, yes, but they are not the bank's to use to cover other promises. The leaked story claimed that a huge chunk of the metal in the building was effectively spoken for, legally owned by an external entity. So, when you subtract what's held for others from what's held for the bank's own obligation pool, the available inventory shrinks brutally. Then it gets worse, because even available inventory isn't always available. The spreadsheet allegedly had a section on leasing and repo activity. That's the polite term for we lent this metal out. Lease agreements let borrowers take silver, sell it, use it, and promise to return equivalent ounces later. That can work in normal times. In normal times, borrowers can buy back later. In normal times, the bank can roll agreements. But in a squeeze, later becomes the most expensive word in the dictionary. So the leak narrative said, after removing custodied metal and then accounting for metal loaned out, the true deliverable ounces left in the vault for the bank's own clients were basically the same as the allocated number, roughly 3 million ounces. And if that's true, and if the obligation number is anywhere near the tens of billions of ounces, the effective leverage ratio is not a few hundred to one. It's not 500 to 1. It can explode into the thousands to 1. That's where the 4,000 to 1 concept comes from in this story. It's a simplified average of extreme leverage across multiple clearing entities, with some institutions worse than others. Now here's why you should care even if you think the leak is exaggerated. Because a fractional system doesn't need to be fraud to be fragile. A bank can run an unallocated pool honestly within the rules, and it still breaks if too many people ask for delivery at once. This is the same logic as a bank run on cash deposits. Most deposits are not stacked as bills in a basement. The system depends on behavior. So the real question isn't, is the ratio exactly 4,000 to 1? When the real question is, what happens if the behavior changes? And that's the part that feels different right now. Because for decades, silver paper was a game. You wanted exposure, you bought a fund, you traded futures, you held an unallocated statement, you rolled positions, you collected returns. Physical delivery was niche. Industrial users got supply through long contracts. Retail bought coins as a hobby or a hedge. The system could survive because the delivery demand rate stayed tiny. But if the last year has taught us anything, it's that behavior can flip fast. When a market believes inventory is fine, people are calm. When a market suspects inventory is strained, people get curious. When a market believes inventory is fiction, people stampede. And the leak narrative says that in late 2025, industrial demand behavior changed. Not investors playing with exposure, actual manufacturers, companies that cannot substitute paper for metal. Because you can't solder a circuit with an IOU. You can't code a solar cell with a spreadsheet. You can't build a high-efficiency connector with a promise. So if large industrial buyers start insisting on physical delivery, the system doesn't just get tight, it becomes binary. It either delivers or it cash settles and admits it can't. And that brings us to the mathematical portion of this story, because the leak narrative isn't just dramatic. It's trying to claim inevitability. Here's the mechanism. A fractional reserve system survives if redemption stays below a threshold. If leverage is 4,000 to 1, then the system can only meet delivery if less than 1 out of 4,000 claimants show up asking for metal at the same time. That's 0.025%. So the entire architecture depends on the assumption that delivery is rare. Now imagine delivery demand jumps to 0, 10%, or 0, 15%. Those numbers sound small, but in a system levered 4,000 to 1, they're a wrecking ball. Because 15% is 6 times the safe threshold. It means for every ounce available, there are multiple claimants who want it. And when multiple claimants want the same ounce, the only resolution is price. Price becomes the rationing mechanism. The market raises the price until enough people choose cash instead of metal. That's how clearing happens. The price climbs until the crowd thins. Now, the leak narrative tried to do what every good financial drama does, put a number on the screen. Not higher, not massive, a specific level that feels like fate. You've seen people throw out ridiculous silver targets for years. Most of them are vibes. This story tries to sound colder. It tries to model an equilibrium. It starts by making an assumption. A portion of demand is inelastic. That means it doesn't vanish just because price rises. Industrial users have deadlines, contracts, and production lines. They don't just stop instantly. So suppose a large chunk of demand must buy physical regardless of price, at least in the short run. Then the remaining chunk of demand, speculators, passive investors, paper holders, can be bought off with higher prices and cash settlement. That's where reset talk comes from. The price must revalue high enough that the paper claimants accept cash, and only the truly desperate physical demand remains. And if you want to model that, you can attempt a clearing price, the level where enough paper exits and enough physical comes to market to meet the remaining must-have demand. But here's the twist. In a real panic, the price doesn't glide to equilibrium. It overshoots. When fear hits, people pay anything. Then, after the spike, the price drifts down to a new stable level. So the story built a path. A fast spike, a chaotic spread between paper and physical, a crisis in delivery-based products, then a forced cash settlement event, and finally a physical benchmark emerging at a much higher price. That is the cinematic arc. But the real reason this story is spreading isn't because it's cinematic, it's because it feels plausible given what people already suspect. Too many claims, too little metal, and too many players who only need the illusion to last one more day. Now, let's talk about that illusion and why a leak like this, if believed, becomes self-fulfilling. A rumor about a bank can be ignored. A credible report can be argued. But a spreadsheet? A spreadsheet is dangerous because it looks like the inside of the machine. Even people who don't understand markets understand a spreadsheet. Rows, totals, ratios. And if millions of people see something that looks like internal inventory versus obligations, the first reflex is not to debate. The first reflex is to protect yourself. That's how behavior changes. And the moment behavior changes, the stress becomes real even if it started as just fear. That's what bank runs are. That's what liquidity crises are. That's what every impossible collapse looks like in hindsight. The system didn't fail until everyone acted as if it would. So let's walk through this scenario the leak narrative lays out step by step. Because even if you don't buy every number, the timeline teaches you how squeezes unfold. First, mainstream coverage. When major outlets publish, the story stops being forms. It becomes financial news. Second, futures reaction. Paper price gaps, margin requirements rise, volatility increases. Third, physical divergence. If delivery is the issue, physical markets pull away from paper. A spread opens. Arbitrage fails because you can't ship what you can't source. Fourth, pressure on delivery-linked vehicles. Funds that claim metal exposure get redemption stress. Authorized participants ask for bars. Custodians slow walk. Fifth, policy changes. Banks and exchanges quietly shift rules. Longer notice periods, higher minimums, delayed settlement, subject to availability language that tells you everything without saying it directly. Sixth, the breaking point. The market flips from deliverable to cash settled. That is the moment the paper contract admits it cannot guarantee the thing it was supposed to represent. Seventh, the new benchmark forms. When paper breaks, physical becomes the only truth, and the price becomes local, negotiated, and ugly until a new reference emerges. That's the template. Now, here's where we need to slow down and be honest. This is a dramatic scenario. Real markets can behave differently. Institutions have backstops, emergency lines, and political protection. They can change rules, suspend trading, negotiate settlements, and stretch timelines. But those tools all have one cost: credibility. Because every time the rules change in the middle of the game, more players stop playing paper and start demanding real. So the narrative's core claim is not this specific date will happen. The core claim is, if the world believes the leverage is extreme, the world will try to redeem, and the leverage cannot survive redemption. That is the logic. Now this is where I want you in the comments, because your instinct matters here. Do you believe most people would calmly accept cash if they suspected a physical shortage? Or do you think they'd stampede into delivery and physical buying? Which reaction do you think is more likely when fear spreads up? And here's the second question. If you owned a paper silver product today, and you saw a credible report suggesting extreme leverage, would you exit immediately? Or would you try to ride the spike and time it? Be honest, because that decision is exactly what determines how violent a squeeze becomes. Now let's talk numbers in a way that doesn't pretend certainty but explains the pressure. When you hear trillions of dollars of exposure, that doesn't mean trillions will need to be paid in cash tomorrow. Notional is not the same as immediate liability, but notional tells you the scale of promises. If the promises are huge and the deliverable base is small, then small shifts in behavior can create outsized price moves. That's why commodities can gap like a stairwell when shortages appear. The float isn't like stocks. You can't print bars overnight. So what would a reset price even mean? In this story, a reset price is the level at which paper obligations can be extinguished without needing full physical delivery. It means enough holders accept cash, and enough holders sell physical to satisfy the remaining must-have buyers. There's no single formula. But you can model it using a few inputs: how much physical exists, how much is truly deliverable, how much demand is inelastic, and how much supply appears at different price points. The leak narrative claimed a post-panic stabilization around the mid-hundreds per ounce, after a spike above that in chaotic trading. The point isn't the exact number. The point is magnitude. Multiples, not percentages. Because in a squeezed commodity, price doesn't move in polite increments. It reprices in lurches. Now, let's bring this back to what you can actually do with this information without turning this into fear-mongering and without pretending we know the future. If you hold something that is purely paper exposure, understand what you own. Read the prospectus. Know if you have a right to meddle, and if so, under what conditions. Many vehicles are designed for price exposure, not delivery. If you hold unallocated accounts, understand the counterparty risk. Unallocated is not automatically bad, but it is a claim, and claims matter most when the crowd demands performance. If you hold physical, understand liquidity. Physical protects you from paper failure, but it also introduces spread, premiums, and sometimes the temptation to sell too early. And if you are thinking about entering, understand that the easiest time to buy physical is when nobody cares. The hardest time is when everyone suddenly cares at the same moment. Now, let me drop something important here. There's also a massive difference between silver is tight and silver is unobtainable. Tight means high premiums and delays. Unobtainable means contract failures, forced cash settlement, and rule changes. And you don't need a leaked spreadsheet to know which direction we've been drifting. You've seen delivery times extend. You've seen premiums spike and stay high. You've seen certain products vanish. You've seen industrial headlines about supply chains. Those are the signals that behavior is shifting. Now, I promised cliffhangers, so here's the one nobody talks about. If a paper-silver crisis erupts, it won't just be about silver. It will be about trust. Because silver is not only a metal, it's a financial instrument, it's an industrial input, it's a collateral asset, it's a confidence symbol. And if a major market is forced into cash settlement, the message to the world is simple. The paper was never the thing. That message doesn't stay contained. It spreads into every other paper promise that depends on confidence. So the next question becomes, if silver paper breaks, what else gets questioned next? That's why stories like this, verified or not, matter. They change the psychology of markets. They push people from exposure to ownership, from trade to take delivery, from paper comfort to hard reality. And that brings us to the practical timeline, pressure the story emphasizes, Monday open. Whether or not the story hits mainstream headlines exactly on Monday, the broader concept is that markets reprice when perception becomes widespread. If this leak gets traction, the first wave isn't institutions. The first wave is retail panic, followed by institutional hedging, followed by industrial pre-buying. And the industrial part is the most brutal because industrial buyers don't hedge for fun. They hedge because they must. When they pre-buy, they lock supply away from everyone else. That's what creates the feeling of there's nothing left. Now, let's insert the quick creative detour I promised because it matters for many of you. If you're also into silver-related success stories, real people, real moves, how they positioned, what they learned. There's a link in the description to another channel that covers exactly that. Go check it out and subscribe over there too, because watching strategy play out in real life can be more valuable than listening to any one person talk theory. Back to the leak narrative, because there's one more piece that turns this from market stress into market rupture. The mismatch between paper settlement price and physical reality. If paper breaks, institutions will try to settle at paper prices, but physical will trade where physical trades. That creates a moral hazard. People who thought they owned metal discover they owned a coupon, and the coupon can be redeemed for cash at yesterday's price while the item itself is selling for twice as much down the street. That's when lawsuits happen. That's when politicians get involved. That's when regulators pretend they are shocked, and that's when rule books get rewritten. So, what would a smart institution do in that environment? It would slow everything down. It would raise margins. It would impose notice periods. It would offer cash incentives to settle. It would change delivery windows. It would do anything to avoid a sudden public, we cannot deliver moment. And that's why you need to watch not just price, but policy. In crises, the most important signals are the quiet rule changes because those are the tells. Now, let's address the most common objection. If this were real, why hasn't it blown up already? Because leverage systems can run for decades as long as redemption stays low. That's the secret. The system doesn't collapse because it's leveraged. It collapses when the crowd tries to redeem. And the crowd redeems when they lose trust. Trust is the fuse. A leak like this, again if it's believed, lights the fuse. Now, I'm going to give you a realistic way to think about the price path without pretending to predict a specific dollar number. In the early phase, paper leads, futures gap, volatility spikes. Headlines multiply, then physical begins to separate, premiums rise, spreads widen, then the market becomes fragmented. Different regions trade at different prices. Then, if stress continues, paper contracts become less credible. The discount in paper proxies widens. Then, if delivery suspensions happen, paper becomes a reference at best, not a settlement truth. And after that, a new equilibrium emerges, usually at a much higher level because the market has been forced to recognize scarcity. That's the pattern across squeezes, from energy to base metals to obscure commodities. Now, you might be thinking, okay, but why would silver specifically be the one that breaks? See, because silver has a unique profile. It's both monetary and industrial. It has massive paper trade volumes relative to physical. It's used in small amounts across huge product streams. And it's often a byproduct of other mining, which makes supply slow to respond to price. That combination is perfect for a leverage blowout. If demand spikes, supply doesn't instantly surge. If supply can't surge, price must. If price must, paper systems that rely on easy rolling and calm settlement get stressed. And if stressed enough, they cash settle. Now, I'll say something that might surprise you. A cash settlement doesn't necessarily end the game. It changes the game. It can push the real market to form outside the exchange, where the price is based on actual bars moving, not contracts rolling. And once that happens, the paper market can't easily reclaim control because the crowd has seen behind the curtain. That's why math certainty language is being used in this leak narrative. It's trying to say, once the curtain is pulled back, the old equilibrium cannot return. Is that always true? Not always. But it's true often enough that you should respect the risk. Now let's talk about what a reset would mean psychologically, because that's where the virality comes from. If silver reprices dramatically, it isn't just a chart, it's a story that spreads. People share it because it validates a belief that paper systems are stretched, that real stuff matters, that decades of complacency can flip in weeks, and stories that validate fear and hope at the same time go viral. Fear? My paper might be worthless. Hope? My physical might be life-changing. That's the viral recipe. So if you're watching this and you're thinking, is this just hype? Ask yourself something simpler. Do you believe the paper to physical ratio in silver is low, moderate, or extreme? If you believe it's extreme, then you already believe the system is fragile. The only remaining question is the trigger, and triggers don't need to be perfect. They just need to be believed. Now, I'm going to do the one thing most scripts won't do. I'm going to tell you what not to do. Don't assume you'll have time. In the early phase of a squeeze, there's often a window where things still trade normally. People hesitate. They wait for confirmation. They want to be right. Then the window closes and the rules change. Second, don't confuse spot price with acquisition price. In tight markets, spot is a headline. Acquisition is what you actually pay to get metal in hand. That gap matters. Third, don't chase with desperation. If you miss the calm phase, chasing into the froth can be dangerous. In every squeeze, there are spikes and pullbacks. If you act with a plan. Now, I know what you're thinking. Cool story, but what do I actually watch so I am not guessing? Here is a practical checklist. You do not need insider access to notice stress. You need signals that show up in the plumbing. First, watch lease rates and borrowing costs. When lenders demand a higher rate to lend silver, it usually means the metal is harder to source quickly. Second, watch the spread between the nearest delivery month and the months farther out. When near-term contracts trade stronger than later ones, that is the market paying extra for metal now. Third, watch exchange for physical style spreads and the cash and carry trade. When those spreads blow out, it can be a sign that paper and physical are drifting apart. Fourth, watch real-world premiums. If the paper quote dips, but dealer premiums stay elevated, physical is tight even if the chart looks sleepy. Call 2 dealers, ask, what is the earliest ship date if I pay today? And compare answers. Fifth, watch inventory categories and language. When commentary shifts from available to registered to eligible to subject to availability, you're watching a story get rewritten in real time. And here is the sneaky indicator, excuses. In calm markets, nobody needs excuses. In stressed markets, everyone has a story. Shipping delays, maintenance, system upgrades. If the excuses multiply at the same time premiums rise, you're not imagining things. Finally, remember this. Volatility is not the danger. The danger is structural. If margin rules jump, if position limits tighten, if redemption windows stretch, or if delivery becomes optional, that is when confidence breaks. And once confidence breaks, the move happens faster than most people can react, which is why having a plan before the headline matters. One more tip. Watch the industrial side. When manufacturers talk about prepaying, locking supply, or redesigning products to use less silver, that is demand pressure showing itself. Also watch mints and wholesalers. When allocation programs tighten and back order lists grow, that is physical stress, not internet drama. And if you see these signals, pay attention immediately. Now, let's address the part of the leak narrative that tries to pin an exact clearing price. You'll hear numbers like 300, 500, 1,000. The leak narrative pushes a mid-400 stabilization level after a chaotic phase. Could it be higher? Yes. Could it be lower? Yes. But the key is this. If forced cash settlement happens, physical can trade far above paper, and the new equilibrium can be multiples above where it started. And if you want to understand that without any fancy math, here's the simple thought experiment. Imagine 100 people are told they each own 1 ounce, but there are only 1 ounce in the room. If all 100 people are calm, they can trade claims, and the system looks stable. If even 5 people demand to hold the ounce, the room becomes a fight. And the only way to stop the fight is to raise the offer to the other 95 people. Take cash, take a premium, walk away. The higher the desperation, the higher the cash offer. That's it. That's the model. Human behavior meets scarcity. Now let's talk about how institutions might respond, because this is where you'll see the most interesting moves. A bullion bank under stress might do a few things. It might offer conversion to allocated, but with fees and delays. It might restrict withdrawal sizes. It might offer cash settlement bonuses. Take 5% above spot and settle today. It might lean on central inventory sources, if any exist. It might coordinate with other banks to borrow metal short term. It might pressure exchanges to change rules. It might pressure regulators to allow emergency measures. And it might quietly buy metal at any price to patch the hole before it becomes public. Those are the moves you should watch for, not the press releases, the actions. Now, I want to talk to the physical holders for a moment, because the leak narrative tells them what they want to hear, but it also hides a danger. If price spikes, the temptation to sell early will be enormous. You will see headlines. You will see numbers you never thought you'd see. And you will think, this is it. But squeezes can overshoot. They can pull back. They can spike again. They can reverse. They can be messy. So if you plan to sell physical, the smartest way is often stage selling. Not all at once. Not at the first spike. Not at the first correction. A plan. Because the worst feeling isn't missing the top by 10%. The worst feeling is selling at 150 and watching it print 400 while you're stuck reading your own regret. Now, for the paper holders, the danger is different. It's not regret. It's gatekeeping. In a crisis, you might want to sell, but you might not get the price you think you have. Discounts widen. Trading halts. Trading. Redemption windows stretch. And suddenly, you're not in a market. You're in a process. That's why understanding terms and structure matters before panic. Now let's bring it home with the moment this narrative keeps aiming for, the public realization. Because if this leak becomes the talk of Monday morning, the first wave will be people Googling unallocated silver and redemption. The second wave will be people calling brokers and dealers. The third wave will be institutions hedging and adjusting. And by the time the fourth wave arrives, the easy exits are gone. So if you want to be early, you don't wait for consensus. And if you want to be safe, you don't assume consensus will be gentle. Now, here's the cliffhanger you should not ignore. If the silver paper market admits it can't deliver, that doesn't end industrial demand. It intensifies it. Because once industrial buyers see cash settlement, they stop trusting intermediaries. They start locking direct supply. They sign forward contracts with miners. They outbid each other for physical. They hoard inventory. And that hoarding makes the shortage worse. So the very act of protecting the system by cash settling can accelerate the physical squeeze outside the system. That's the paradox. Now, I'm going to give you the cleanest takeaway. Whether or not this leak is real, it's a stress test story. It forces you to ask, what do I own exactly? If you own a bar in your possession, you own silver. If you own an allocated claim with serial numbers, you likely own silver with counterparty storage risk. If you own an unallocated claim, you own a promise. And the promise is only as good as the system's ability and willingness to honor it under stress. If you own a fund share designed for price exposure, you own a financial product, not metal. None of those are automatically bad, but they are not the same thing. And in a crisis, the differences become everything. Now, one last thing before we wrap. Don't let anyone scare you into panic actions you don't understand. Use information to clarify your position, not to melt your brain. Read terms. Ask questions. Be deliberate. And since you're here, I want to hear your take on what happens first when fear hits. The shelves go empty or the price goes vertical. Drop your thoughts below. I read the comments, and the smartest discussions happen there. And again, if you want updates as this story develops, subscribe to this channel. It helps the channel and it keeps these updates coming fast. It's the quickest way to stay ahead of the noise, because if this leak narrative is even directionally true, the next few weeks won't be boring. Take care of yourselves, keep your eyes on the rule changes, not the headlines, and I'll see you in the next one.